Continuing on with study objective 1 in chapter 2, there's a description down here after we've kind of gone through the preliminary analysis of what's in a balance sheet. Long-term investments are discussed a bit further here. Investments in stocks or bonds held for more than a year. Property, plant, and equipment, these are business use, long-lived assets. When we buy these kinds of assets, we don't simply record them as an expense on our income statement and kind of subtract that amount from our overall profit. We have to expense these kind of purchases over time, over what we call our useful life. So we do that through a process called depreciation that we will get more into much later in the semester. But for starters, depreciation is this practice of allocating the cost of assets to a number of years. So in the simplest terms, if you have an asset that costs $10,000 and you think it's going to last for 5 years, then you would simply expense $2,000 per year. 10,000 divided by 5 is 2,000, and you record that expense of 2,000 against your income, your revenues that you make, and in that way you allocate some of that expense to each year. It's not a measure of what the asset's worth. This is, we're used to seeing that word depreciation in our general lives, and it means that the value of something has gone down. In accounting, it does not mean that. It's not a value estimate at all. It is simply a process of allocating cost of an asset over a number of years, whatever its useful life is. This account, accumulated depreciation, simply adds up all of the depreciation that has been allocated to expenses over the life of each individual asset. So after 3 years, in that example I just gave you, $6,000 would have been expensed or depreciated on the asset in the example I just gave you, $10,000 asset. And so $6,000 would be the balance in accumulated depreciation. And if we see how that works down here in the PP&E section of the balance sheet, you have all these assets listed here, and it adds up to all of this cost, and then accumulated depreciation is subtracted to arrive at what we call the book value. And again, it's not really the value of the assets, it's just the cost of the assets that hasn't been depreciated yet. So that's what we like to show in the balance sheet, so people can get an idea of how old a company's long-lived assets are. The bigger this accumulated depreciation number is, the older the assets appear to be. And then if you're an investor, you can say, well, while this company is going to have to be spending a lot of their cash on property, plant, and equipment pretty soon, I might not want to invest in this company right now because I might not get dividend payments. They might have to reinvest in the company. So those are a quick look at PP&E. Intangible assets are discussed a little bit here. Certain kinds of intangibles, goodwill, films, customer lists, franchises. All these things are kinds of intangible assets. They don't have a physical structure, but they are valuable in a company. And we'll see we'll get into some of these kinds of intangibles in more detail later in the book. Current liabilities, we talked about that earlier, same as current assets in terms of the word current, amounts due within a year. Long-term liabilities, amounts due longer than a year from now. And the equity section, again, made up of common stock and retained earnings.